Here we're going to go over dollar cost averaging. This is a very simple strategy, yet it's very powerful. So usually when we try to invest in the market, what we're trying to do is we try to buy low and sell high, right? That's all we want to do. Unfortunately, what usually happens, we buy high and sell low. You get scared and sell low, right? So the solution to this is to try to use dollar cost averaging. What the dollar cost averaging is basically when you buy the financial instrument with a certain interval. For example, let's say we want to buy a S&P 500, right? Sometimes it goes up, sometimes it goes down, right? Instead of buying at one time and wait till it goes up to sell it, what we can do is we can buy a small portion with a fixed interval. So for example, let's say if you have a paycheck that you get either bi-weekly or let's say once a month. So let's say you want to put like $100 on the side to invest into the stock market. What you can do, you can every month put that $100 into the stock market. Sometimes it goes up, sometimes it goes down, but on average, usually the whole market shifts higher, right? So when the market goes down, you buy it actually cheaper, so you don't really get worried about when it fluctuates. So over longer period, like a couple years or 5-10 years, you will see that your return is actually higher. Sometimes actually higher than if you bought it lower at the beginning. Let me show you some examples. So let's say we want to buy one share of our market. Let's say it's like S&P 500 market. Let's say one share costs $100 at the beginning of a period, right? So we invested $100, bought one share. Then in the next month, market went up at some point and went go down again, right? In the next month, we bought the same share of the stock for $110, right? So we might be upset here. We say, oh, we could have invested more at the beginning. But let's see what happens next. Next, the market goes up and then drops, let's say some news, right? Then we buy it at the $70 share, so we bought it much cheaper. Then market goes up again, and we buy it on $1 or $2. Okay, the market goes down, bought again at $80. Boom. And we ended the period at 1 or 2, right? So let's say all this green dots is actually our monthly periods when we invest in the market. Okay, so we have we invested 5 times, right? So that means we got 5 shares, and our final price of that share is $102, right? So if we bought everything at the beginning, right, at $100, and sold it at the end at 1 or 2, we would make only $2 per share profit, right? So let's see how much we actually made using this dollar cost averaging strategy. So we got 5 shares. Average price of our share is 92.5. Basically what I did, I just, summed all the shares divided by the 5. So profit per share, since it's a 1 or 2 minus 92.5, is actually $9.5 per share we made at the end of the period. So our total profit is $47.50. So we made way more than we would have made if we just put all the money at the beginning, because we would have made only like the $10, right? 5 shares and $2 per share. Instead, we made much more than that. That's why dollar cost averaging is very powerful. Over the longer periods of times and high volatility, you can actually generate even more money. All right, that's it for today. Please like and subscribe. Simple Stupid Finance with you.